Well, welcome everyone. This is great. We've got what looks like about 35-ish people so far. I bet we'll have more joining. Um, this is so cool. This is like an experiment that we're doing with all of you and the NCS team who's here with us. Which thank you for being our guinea pigs for this. This is going to be super, super fun. Um, maybe to start, and well, as people are kind of trickling in here, um, for folks who don't know, maybe could everybody from the NCS team just introduce themselves and uh, maybe maybe introduce yourself and name your favorite semiconductor company.
Starting in on semiconductors already.
We got to give the people what they want.
Who wants to start?
I'll start as the semiconductor guy, I guess. John Bathgate here. So my favorite semiconductor company in the ecosystem is Cadence Design Systems, and we probably don't want to give too much background, but we've been all working together for 14 years. So I'm actually the youngest person on the team here, and I've been working with Brinton and Brad and Joe for 14 years. So it's kind of a funny, cohesive group we have.
Yeah, I'm the other semiconductor guy. I'm going to say I'm Brinton Johns, and I'm going to say Fairchild, like the OG, just because it took a lot of guts to go away from Shockley, and then like we can trace back sort of a lot of the modern semiconductor industry from that one. So
that's a very acquired answer for you to give, Brinton.
Yes. Thank you.
I know who the people's favorite is going to be.
He's playing to his audience.
Go for it, Joe. I think you're on mute though.
Yeah, no, I'm Joe Formansky. I'm going to say Wolfspeed because it has the best ticker. And just kind of lay that out there. I am not the semi guy on the team. But...
I do like the choose by ticker. I think that's a good one. So I'm Brad, and I'm going to go more along the lines of Britton's answer. The of all the chip companies I've spent time on, to me, ARM is the most interesting one, just from a historical perspective for like creating this ecosystem and challenging x86 and the whole slew of people. Not necessarily comment on where ARM stands today, but certainly where it's been historically over the last 2 or 3 decades. So.
What's the current status of ARM? Is it
owned by SoftBank? It did not make it out before the IPO window closed.
Yeah.
Yeah, nobody knows. That's a fascinating one. And then you've got ARM China, which has sort of gone rogue, and it's just very interesting right now.
It's like a unique example of like real corporate mutiny where like the company has fractured and there's all these interesting technicalities in China. Like there's a stamp, and if you actually have this physical stamp, you can control the company. And they've kind of like taken the stamp. So it's there's like a very deep rabbit hole you can go down on ARM China. But it's a big problem for them when like half the company is just kind of evaporated.
You can't make this up. And it's not like every device that we ever use depends on that instruction set. So
I can't remember. I don't think we actually talked about that on an acquired episode. Maybe we did, but I remember when we were doing our China Tech series. Yeah, there's this crazy aspect of Chinese corporate law where like you're not making that up. There actually is like a stamp that like there's a physical thing that represents like the vested power in controlling company decision making.
That's wild.
Before we get into it, is there any disclaimer type things that we should say?
Probably. I don't know if we know what they are.
if we assume that this is going to be hosted on your website at some point and used to communicate externally, I think we should probably say this is a part of a paid sponsorship.
Yes, and it is for entertainment purposes only. We are not giving stock recommendations. We may talk about companies. Clients. Yeah, you're not clients. We may talk about companies that we own in the portfolio. Almost certainly we will. These are not recommendations or anything like that. So I don't know. Maybe that covers us.
Boom.
Mostly. Do your own homework, right?
Yeah. Yes. I think we hit all the bases there.
Well, I think David's going to sort of like take us in with a very general high level question, but anyone should feel free at any time to sort of queue up questions in the chat of, hey, I read the paper and was thinking about this, or hey, I didn't read the paper, but I just heard on the episode this and had a particular question or topic area I want to discuss. Also, if you're asking questions, pop off video if you're available to, or feel free to be off video the whole time. I think Dave and I are gonna do that, and anybody who wants to is welcome.
And by
So
off
David,
video, you mean on video.
on video, yes.
Yeah. Well, maybe to start, just warm things up with a meta question. I don't think we covered this on either of our episodes with you all, but where did the idea come from? Complexity.
Brad and I were just talking about this week. Brad and I never trust our memories, so I'm going to give you an answer that's probably not true. It's kind of made up, and Brad may give you another made-up answer. And somewhere
we both have different answers to this.
Oh, this is great. As I said, we're in the depths of AWS research right now, and there are at least 4 very conflicting narratives on the origin of AWS,
Right.
and where the truth lies is very much open to debate.
Yeah, I did. I was cleaning out an office maybe like, I don't know, 9 months ago now, and I came across the first outline, which I wrote down in 2012. And so I know we were thinking about it back in sort of 2011, 2012, and then we wrote most of it in 2013. I mean, some of it came out of just frustration. Like, we had been analysts for a long time, running a portfolio for a while, and, you know, both learned all the things you're supposed to learn to be a good investor. And we're like, none of this works. It's like it should work. I guess it could work in a vacuum, but we're not in a vacuum. We're like in the real world. And so we were just frustrated. And so started reading widely. And we you know, part of the job of being a good investor is you just read all the time. You try to read disparate sources, and you try to challenge your assumptions, and you're always trying to disprove what you think you know, and be adaptable, right? And a friend of mine recommended a book by Beinhocker, Origin of Wealth, and then Brad was recommended a book, Complexity by Mitch Waldrop.
Yeah.
And we started just talking about nonlinear functions, the fact that all these point estimates that we were doing, you know, were completely useless. These big models that we were building were relatively useless, other than discovering the leverage points of the business, but all the predictions they were supposed to make were useless. And then and then it sort of took on a life of its own, and we started writing about it and found it just way more helpful than anything we'd known. And so the lens that we went to was this biological lens, this nature lens, right? So we're pretty sure nature works, but like economics is relatively young science, and oftentimes it has nothing to do with our current world. And so we thought, wow, nature could be way more powerful than this economics lens. But I don't know exactly. I don't know, Brad, what you remember.
Yeah, I think there's like 3. What's always interesting to me is whenever I see something three times from 3 different places, it's like a weird pattern thing that I look for. And I think we kind of came at complex adaptive systems and the Santa Fe Institute from 3 different directions. And the third one was when a friend of mine, Randy Bafuma, who was Bill Miller's director of research at the time, said, hey, like, you guys should go get involved with the Santa Fe Institute. It's the home of complex adaptive systems. And by the way, it's not very expensive to join their business network, and it's like the highest ROI thing you can do. And we're like, okay. And so I think after we had been reading these books, we ended up landing there and attending some seminars that they had done. And it was really just like trying to understand, like, okay, we've been at this for a while, and we've done pretty well, but we've made a lot of mistakes. Can we come up with a framework that explains the mistakes? And this complex adaptive systems lens seemed to be not only the most explanatory, but also in terms of the mistakes we've made, but also gave us this sort of cure for it to try and not avoid all, but some of those mistakes going forward. And so, yeah, it's 10 years this October from when we wrote the rough draft of the sort of outline of the paper. And I'd say ever since then, we've sort of grown slowly more confident that this is the right framework we've adapted it a little bit here and there, but that it does work for not just investing, but for building a company, a resilient organization, and a whole host of other things where like high important decisions have to get made.
I have one sort of like topic on this that I've been thinking about since rereading the white paper, and I'm curious how you guys think about it. So we're taught in elementary school you should learn from your mistakes. You touch the stove and it's hot, so don't do that again. And I think one of my big takeaways from complexity investing is discussing a number or an average sucks, and because you lose the shape of the distribution. An important thing is knowing not like the one data point you can know, or collapsing an entire rich distribution into one number like an average or like a median, but like really trying to understand the whole distribution. But we only live in one strand of the multiverse. So when I make a mistake, quote unquote mistake, and something bad happens to me, should I try to learn from that? Or maybe I actually made the right decision and followed the right process, but this particular universe that we're in didn't reward me doing the right thing. And so how do you think about when you should learn from your mistakes versus when you should say the world is complex and random and my right thing just didn't get rewarded?
Who wants to start?
Oh man, both of us have long answers, so probably only one of us should give a long answer. Go for it, Brad.
Well, I think so. Yeah, it's this idea that it's the individual path through time that matters, and in a lot of the analysis that you see done, and when people sit down to build a model or forecast their company, we're really just kind of taught to think in averages, but nobody really, maybe one person experiences the average, but the average is the average because it's a whole bunch of different things. And so your individual path through time is what matters. And this comes from the concept of ergodicity, which probably we don't have to get into on this call, but it is mentioned in the paper, and we can follow up with more resources if people want to dive into that. But yeah, I think, what's really, I think, comes out of understanding complex systems is you do need to properly attribute skill and luck. And, luck is always way more than we think it is, both good luck and bad luck, and skill is always way less, both good skill and bad skill, than we think it is. And so it is sort of determining like what led to this outcome. Was it just this fact that we're sort of in this complex adaptive systems and all these interacting agents just created this totally unpredictable outcome? There's no way I could have gotten it. And if I had gotten it, it just would have been pure luck. Or was there some question I could have asked or answered to get me to a different spot to have avoided this situation? And, that's where I think this idea of like, well, we can't predict the future because it's just too complex to know, but can we figure out the right questions to ask, or when something does happen, can we go back and look and see, like, was that something we could have figured out, or was that just, do we just move on? But I would say it's not a framework for just blaming the universe. It's sort of not a framework for nihilism, but it is a framework for maybe trying to begin to understand what was luck versus what was skill.
Yeah, just to sum it up quickly, are we making the types of mistakes that we should be making? Or was that a mistake that was a legit mistake? Did we touch the stove when the the coil was red hot? Like, let's not do that again. But there's lots of mistakes we should be making, and we're going to continue to make, because those are asymmetric and high probabilistic mistakes.
One thing I said to a potential client earlier today was, we get nervous if we aren't getting some stocks wrong, because if we're not getting stocks wrong, then we don't have enough asymmetry or wide range of outcome stocks in the portfolio. Like if you're not making any mistakes, then you're not taking enough risk, right? That's sort of
right.
You should probably just own an index fund in that case.
Yeah.
Well, it's interesting. Like 100% of the time the stove is red and hot, you shouldn't touch it. So like that's a mistake. You just generally like should you objectively know with enough data, like you should not be making that. But if you have like a game that you can play that pays out twice your money every other time, but your chance of losing money is much lower than that, you should keep playing that game, even if the first spin of the wheel results in you losing money. Like you should,
Yeah,
it's a
absolutely.
different type of mistake than the
Yeah,
risk of-
the problem is though there's a scenario where you can spin the wheel 20 times and unexpectedly lose 20 times in a row.
right.
So
It's like
always,
it's like a
True.
4 or 5 sigma
yeah,
thing. in the
it does
distribution,
happen.
but-
That's how you get to the average, is that happened to somebody.
This is why private company investing and preferred stock and preference stacks are are a good good downside protection. Bunch of questions in the chat. One I realized we should have started with, but let's do it now. From Michael, can you all recap for everybody, just so we start on the same page, kind of the core principles of complex adaptive systems analysis and complexity?
I think I can give a pretty quick answer, hopefully, and then if it's not enough, we can go into it more. But basically, a complex adaptive system, from like the science of the definition, is any system of interacting agents where the interaction of those agents creates emergent behavior, something that wouldn't have happened if those agents hadn't been mixing together in some way. So that can be a molecule, like a gas cloud, or it can be people in a company, it can be stocks, it can be the economy. It's really anything. So it's sort of like weird, like, so you're just saying like complex adaptive systems are everything, and the answer is yes. But when you think about them in this specific way, that there's this interaction, there's emergent behavior, you get these, increasing returns happen. So a small change in the sort of the way people are behaving can create this huge ripple effect down the road. So that's that kind of concept of chaos, which comes out of complex adaptive systems, or is closely tied to it. And then the key, there's sort of two key takeaways, at least what we took away from this, particularly as it applies to investing or running a company, which is it sort of instructs you that the world works biologically, that it's a complex ecosystem of interacting, living, breathing things, and that's very hard to predict. And so in order to navigate that ecosystem, you need to be adaptable. So think about the most adaptable species that have survived over millions of years or hundreds of millions of years, or how did humans last as long as we've lasted? We're very adaptable in the way we do things and the way we think. And then this concept of non-zero sum, which is the name of our company, which is win-win, which is the way an agent navigates through this complex system is by having interactions with other agents in the system where you're both better off. So if you both can interact and walk away better off than had you not come together to begin with, then you've created a non-zero sum outcome. So those are the two things that work in biology. And I think our kind of insight a decade ago was like, oh, that's actually what works in the economy as well.
Oh, I love that. Okay, that's perfect. Next question in the chat that I'll do, and then probably should have said this up front. Anybody who wants to ask a question, why don't we do the hand raise function on Zoom, and then we'll just have a queue of folks, and you can ask directly. I think that'll work better.
Kick it to
given the
Josh to ask his own question.
Yeah, Josh, if you'd like to ask it yourself, either just go for it or let us know if you would not like to go on video and do it. Then I'm happy to ask it for you.
Hi, thank you guys. I just wanted to say thanks first, both from NZS and Acquired. I love your guys's podcasts and written reports, and it all always makes me think a ton. So thank you. My question is about some of your favorite examples of complex adaptive systems in biology and nature. I think that transfer to investing. I think some of the ones you've mentioned are with bees, kind of in new environments, how they may be more exploratory, and then when they're comfortable in environment, it's more exploitative. And then ants as well. I think you guys have spoken about that and the redundancy factor. So just curious to hear if there's other ones that you guys have been reading about recently, or just general favorites there.
There's so many. I'm a beekeeper, and so I've been a beekeeper for just over 10 years now, and it's kind of a hobby that's turned into an obsession. And so I just going to go back to bees. I'm sorry to be boring, but another lens on bees is the way bees. So bees are not native to North America, or honeybees are not native to North America, right? They're brought over by the Europeans. So how did they get everywhere? Well, the way bees propagate is they swarm. So many of you may have seen this in the springtime or seen on the news or something. There's a ball of bees on a bush or a tree. Everybody sort of freaks out, right? And what's happening is the best way to think about bees is as a superorganism. And as a superorganism, they're most like mammals. So they have about 1 to 2 kids a year. I mean, not that we have that many, but in our lifetime we will. So, right, and those are swarms. And so what happens when bees swarm is in the springtime, when things are about to get good, the weather's about to get nice, all the flowers are blooming out, there's lots of food to eat, the colony will take the old queen, and she will then take about 1/3 of the bees with her. They all sort of tank up on honey. Bees have 2 stomachs, so they can take up on honey, right? They will fly out. Now, the queen's not a very good flyer. Most of her life, she can't fly, but she loses about 1/3 of her body weight. She flies out, usually to a tree that's pretty close, because remember, she's not a very good flyer. And then all the bees sort of come around her, and they form this ball of bees that interlock their legs, and that's what people see. Turns out that when that's happening, bees are at their most docile, so they're not dangerous at all. They're fat and happy. They've literally just tanked up on honey, and they're going out to look for a new home. So there's a great book called Honeybee Democracy, written by Tom Seeley, who is a professor at not Dartmouth, Cornell, upstate New York College, yeah, Cornell. And the bees are going out and trying to find a new home, and they come back and they vote on it. And finally, when they figure out they vote on it, they actually will all go together, and they do this through heat. They communicate through dancing and also through heat. And then they'll warm up the ball, and they'll all go to the new house together. Now, what's happening in the old hive that's queenless? Well, they're actually raising new queens, and they stagger them. So the new queen, the first one will hatch. She goes out, she has a mating flight. She mates with a bunch of drones in the drone congregation area. I don't know why there's not a more creative name, but there's not. She will then mate with 20 to 30 drones, and then she'll be mated for her whole lifetime. She comes back to the hive, and if she makes it back to the hive, she will sting the other queens in their cells and kill them. So the queen is the only bee in the hive without a barb on her stinger, and so she can do that. If she doesn't make it back, they have a plan B, C, D, and E usually. So what I've just explained is resilience and optionality, right? Which is a great way that nature does that. And I could go on, but I'll stop there.
I don't know that we have like a lot of new examples, because bees and ants are just such great examples. There's one thing I've been thinking about, which is just kind of like more solitary species versus more communal species, because obviously bees and ants are very communal. And I do think there's just, you look at some of the sort of longest lived species or most highest number of species that are out there, and you do find a lot of like the more solitary, in the feline category or things like that out in the wild have tended to not proliferate. Part of that's because we killed a lot of them. But it tends to be this sort of concept of teamwork that just is like so powerful, and this sort of just fact that you can't survive on your own. There's always some kind of reliance either on a pure something else in your species or something else in the ecosystem around you. And there's a lot of examples from the ocean from that, and just a lot of that. So I don't have any good specific ones, but
yeah, these social insects are the best, I think. E.O. Wilson writes a lot about them. If you ever want to read someone fascinating, E.O. Wilson. Sorry, Ben.
Do you think the idea that like humans build tools is sort of a like counterexample of we're a species that doesn't require this as much? And we had sort of, to expound a little bit, like we had very pathetic tools for a long time, but now you can totally exist all the way on your own without a society around you, without a company around you. You can make a living on the internet. There's like a variety of ways to illustrate that we don't have as much community reliance required as we used to. And so do you think we're like humans are on like a potentially a divergent path?
Oh man, you just opened a can of worms for Brad, and he's like biting, he's chomping at the bit.
No,
right now.
I won't go that long. I do think it's basically like a trick. There's sort of like an illusion here that of this this ability to self-rely. I mean, I think I think we're probably more reliant on each other than ever, but it looks like we're the least reliant we've ever been on each other. And so I think that's like a lot of what technology has done is give us this sort of false sense of independence. But I don't think it's true that can be self-reliant in any way. If anything, I worry that, it just seems like we're so less skilled than we used to be. I don't know how many people on this call are good with a knife, for example, which is a pretty important skill to be self-reliant. I know I'm not. So yeah, no, I do think it's like we're in this weird spot with technology where it's created this sort of anonymity and independence feeling that's not actually real. I suspect it's not real, but
I totally agree with that. I think actually Brinton is probably pretty self-reliant, and I suspect you're good with a knife. You're at least good with bees, which is probably all you need to survive.
Could be. Yeah, honey's the new, monetary system in this world that we're making up.
Okay, so we have this is genuinely actually a question asked to me from an anonymous person in a DM here in the chat. I promise this is not a plant. You all, and it is also a true premise of the question. You all both individually and NZS certainly come across in all of your public, writings, thinkings, and knowing you, most of you decently well at this point is genuinely true of you as humans. You're quite humble people, which is not always the case with public-facing investors. Not always not the case, but often not the case. And so sort of a two-part question. One, do you think about that individually? And if so, do you do anything to try and kind of maintain broader perspective and humility? And then two, maybe I'm curious also on your thoughts of like, is there value in humility as an investor?
I think that John or Joe should answer whether we actually really are humble or if it's all
Right.
an act.
Totally.
Yeah, I think it's, part of our group, I would say it's self-selecting, that we, the investment management, or like our organization, or I would say the industry as a whole, is not totally full of humble people. And as we kind of like thought about who we want to work with for the next, hopefully 10 or 20 years, it was certainly self-selecting that we kind of chose to work with humble people. I think one of the key parts of being a public markets investor is it is just a humbling job. Like, you are wrong all the time. And especially actually with our framework of like experimenting with optionality, we're probably wrong more than most public markets investors. And that's okay. I mean, kind of going back to one of the original questions on like, how do you know if you made a mistake, or if it was a learning mistake, or just the wrong copy of the multiverse, like whatever reason it is, you're wrong all the time. And so I think having a humble team around you, where like no one's trying to pile on and say, hey, you were stupid for that idea, or like what you were thinking a year ago of the range of outcomes for this company was totally wrong. I think that's just really important to a great culture. And so I do think we are genuinely like a humble team. It's just a value of, to give credit to Brinton and Brad. Joe and I kind of grew up in the industry working with them. And that was just something that we learned from them a long time ago. And whether you're in a small organization or big organization, it's a lot more fun and easier to just be humble and roll with the punches than kind of like thump your chest and then you realize a year later you were very wrong and you have to kind of like eat humble pie. And maybe we've each done that from time to time also. But anyway, I'll pass it off, but that's kind of my take on it.
I mean, I would disagree. I mean, in this line of work, it's all about intellectual curiosity and intellectual honesty. You have to be honest with yourself and admit when you're wrong. Because if you don't, you end up digging your heels in and just keep making the same mistake over and over. I mean, you might say, hey, that oven was hot. No, the oven wasn't hot. It was the oven's fault for it getting too close to my hand. And you keep making the same mistake over and over again. You can't have that mentality going into it. And so I think it's very important to be humble, but also, it allows you to be open to make mistakes and not afraid of making mistakes as well. Because as John mentioned, the culture is not a, hey, I'm better than you kind of culture. We all own, the same mistakes equally. And so it allows us to be able to have the freedom to make those mistakes, because you have to be willing to make those mistakes in order to find that next great idea.
I'm slightly uncomfortable with this hot oven or hot stove example because I burn myself so often cooking that we keep multiple live aloe plants around the house so that I can like cut a piece off and put it on. That's a true story. I'm really bad at not burning myself. There's actually, as luck would have it, there's actually a chart in complexity investing, a diagram towards the end that Brinton came up with, which is there's a tension between humility and confidence, because if you're too humble, you can be sort of paralyzed. If you have too much humility, you can sort of never make a decision. And if you have too much confidence, then you can make a lot of bad decisions. So there's this sort of chart that shows like you're kind of bouncing between trying to like thread the needle of confidence and humility. And we try to be humble about our mistakes, but we're also in this to win, and it feels good to win. And so it's kind of making sure like not feeling too good when you're winning and not feeling too bad when you're not, when you're losing. And we all go through periods like that, and just trying to kind of like bounce between like anytime you start feeling like a little bit overconfident, just try and bring a dose of humility back in. And I don't know, it's important to have a team, like a good team.
Yeah, it's like
foster that.
I feel like humility, well, certainly any individual and probably a team two's emotional mind state is a complex adaptive system, right? Like just because somebody individually or a team is humble at a moment in time, given the path that goes forward, they may or may not be. And yeah, you kind of like need to have some sort of guardrails or self-correcting mechanism on that.
Yeah, this
It's almost
also
like, go ahead, Brinton. We talk over each other all the time.
Yeah,
Spread
and we
us this
tag
long to do
on,
this.
so we're like insufferable for tagging on. We're sorry.
Go ahead, Brinton.
I was going to say there's this also when you give up this illusion that you can predict the future, then your favorite words are "I don't know," because you really don't, and neither does anybody, by the way. So you're in good company. Just other people may sound really good at making up answers. And I mean, back to the premise that investors aren't a humble group. Investors are just really good at bullshitting answers. That's the main thing, right? So they don't sound humble; they're overconfident. And we know this, like not my opinion, right? So when you get comfortable saying, "Man, the future is really hard to know with any degree of confidence," we say this all the time, but in the financial models, nobody had COVID in the DCF for 2020 and 2019, right? That didn't exist. So I don't know, and maybe, and let's see, and let's be adaptable. And that may sound a lot like humility, and I think it is, but it's just honesty also.
It never ceases to amaze me. I'm so much more attuned to it now, sort of post-COVID or after COVID having happened, to people all the time, like say like, oh, well, they speak with a high degree of confidence of like X, like, the markets are going to be X in 3 months, COVID is going to last 6 weeks and then lockdowns will be over, like all of this stuff. And like, it's very easy to be like, oh yeah, of course. And then you're like, no, actually, like nobody actually knows that. Like, or, interest rates are going down, interest rates are going up. Like you have no idea. Like, totally.
Yeah, we kind of joke that, the portfolio, the NZS portfolio at least kind of went live at the very beginning of 2020. And so this has been like the ultimate exercise in not predicting the future because, January 1st, 2020, we didn't predict COVID. We didn't predict this like crazy experiment with zero interest rates all over the world right after that. Didn't predict the worst inflation in 40 years, right after that. And so I kind of joke with Brad goes on CNBC once in a while. I'm like, tell everyone your year-end, 2022 S&P 500 target price. Because like no one knows. No one has any idea. No one knows where inflation will be. And that's fine. And if you can, like that's amazing. Good for you. You should, make hundreds of millions of dollars for yourself.
Yeah, you probably shouldn't tell anybody if you actually do know.
It's a very good point.
I think one of the biggest tension for investors is like we're told our job is to predict the future. When we first published Complexity Investing, we had a salesperson or client-facing person that we work with say like, you can't tell the client that you're not predicting the future. They're hiring you to predict the future. And we're like, we need to find the clients who understand that we can't predict the future. But it is really uncomfortable, especially if you've been sort of trained like traditionally as an investor the whole time. It's like you're like my job. I come in every day and I'm supposed to make predictions and I'm supposed to get them right. And to actually really physically transform your brain to say, my job is not to make predictions. My job is to put a portfolio together that recognizes the fact that I don't know the future is just like just impossible. Like it's we've been doing it for a while and we still make the mistakes. It's just a really hard mental model shift to make.
All
All
right,
right,
I
have another
Ben
topic from the paper.
and Larry have their hands up. Ben, I think you had yours up first.
Yeah, so speaking of making stuff up and sounding smart, David and I have unfortunately honed the skill of being able to make anything sound good. And so we're almost like a disadvantage. I was pitching a friend
Shh,
on
don't
this
tell anybody, Ben.
this idea the other day that something was a root mow. And I'm going to ask you to define that in a minute. And then I realized like it was coming across compelling because I'm a professional business podcaster and it could be a value trap. And there's this great diagram that you guys have of like, seek this out of the money optionality and avoid value traps. And I'm curious, like, one, can you share the idea of what those two things mean with everyone? But then two, can you talk us through like a conversation you actually had at the firm where someone was like, hey, here's my belief that there's resilience with out of the money optionality here. But there was tension and you had to figure out what to do with this person's assertion that there could be a root mow here and that it wasn't a value trap.
Oh man, such a long answer to that one. I'm going to try to be concise and we'll see how far I get. First of all, rootmo came about because we gave a copy of the paper to Michael Malbison in 2013. And he read it and he said, oh yeah, and that reminds me of the 97 initiation that I did on Amazon. Of course, Amazon is still his largest holding. And I valued Amazon as a series of out of the money options. And we'd sort of thought of this and we'd written about it too, this resilience without a money option. And then Brad came up with this acronym ROOTMO, which is like the geekiest thing ever until we loved it, and so that's ROOTMO. It's this resilient base. So one example we use sometimes is eBay, right? eBay was a declining marketplace. They had PayPal. They got a new CEO, John Donahoe, which was amazing. Turned out to be a incredible CEO. They turned around marketplace, but you got PayPal for free. All you had to believe is that marketplace could be modestly a growth business again, and then PayPal was completely out of the money. So what that allows you to do is make it a big position. Like you can make it a 4 or 5% position now because your downside is so low, but your upside is still double, triple. Barely ever find those, especially in this market, but that's what we always work for. And then there's this idea of the team. We're all great bullshitters or we probably wouldn't be here. And so the team has to be able to have the safety to say, no, you're just telling yourself a story. That's not true at all, which is really uncomfortable. So I would say for us, there's always tension. There's always disagreement. There's hardly ever agreement. And when we agree, we hate it. It makes us feel terrible. We're like, what's wrong with us? Why aren't we all agreeing on this? And so it's the team, right? It's the team that's the magic. That's the pixie dust for the whole process. It's why individual investing doesn't tend to work very great. And in the team, the pixie dust is psychological safety. I have to be able to call you out on something and not have repercussions. But most teams can't do that because there's hierarchy. And in our team, there is no hierarchy. We all have the same title. We all have the same function. And so, Joe can say, Brinton, you're full of it. In fact, he has multiple times. There was a stock that I loved in our previous job, and Joe came out and took an independent look at it and said, no, we should sell it. This is a neutral. And Joe was right. Right. So it's that ability to call each other out. And I'm sorry, I wasn't very succinct.
It's easy to remember that time because that was the only time I've ever been right. And Brinton's been wrong. So
Not true.
And maybe can I ask a little bit more specifically, and then you don't have to name a stock or something, but maybe how does the process work where someone brings something to the table and says, we just did the Amazon episode. So, hey, the stock market is valuing this thing as a retail growth business currently, but they're working on this cloud computing thing. And if it works, it could be unbelievably cash generative. How do you sort of like talk as a group about whether you think there actually is out of the money optionality there, or whether you think that it's alluring to believe that there is, but there actually isn't? Like, and that's basically a position sizing question, I think.
Yeah, and I don't know if John or Joe, if you guys
Yeah,
can
that's what I was
think
gonna
of
say.
examples. I have some we can go to, but
Well, I was just going to say, when we look at, obviously we talked about those two parts of that with the resilience and the out of the money optionality. I think with the big part we have the biggest debate on is the resilience portion. Is a business truly resilient? There's been a number of companies out there that, they have an out of the money optionality, but the core business actually isn't resilient, and that destroys more value than that optionality might have actually turned around and paid you. So that is something that we debate quite a bit and discuss is the business underlying this root moat, is it really resilient? So that's one area I'd highlight, is that finding resilient and out of the money option is very difficult, and finding resilience alone is actually really, really difficult in itself.
yeah, is it really trying to like identify what is the source of optionality first before whether we're paying for it or not? And sources of optionality can be, new adjacent businesses and TAM expansions. It can be M&A. It could be just an incredibly adaptable management team that is going to pull some sort of magic trick and create value. It can be duration of growth. The market thinks companies are going to grow for this long, but it's really going to grow for much longer. There's sort of all these sources of optionality, and then there's always these like negative sources of disruption too that might not be priced in. So you can have like negative options that you want to be thinking about, and then like valuation is the last piece of it. And you kind of come and you say, a very high valuation means that you better have that optionality, and you better be right about it, and you better be right about the timing of it. It's a very hard parlay bet. And a low valuation means like I don't know. I think we reached a point in, I think, June in a lot of enterprise software companies. I don't want to name a name, but you could just name anyone, almost anyone. There's a handful that still held really high and still hold super high multiples, like north of 10 times. But there was a really large group of enterprise software companies trading, less than 5 times, less than 6 times, in some cases less than 4 times sales, through companies that are growing over 20%. And in that case, actually, the entire, weird to think about it, but the entire future is out of the money optionality, because the churn is very low in these businesses. And if all they ever did was keep their core customers with a sort of modest churn rate and never grew again, they would still be good investments. And so there you got to just this sort of silly point, in our opinion, on valuations for software, where the actual just business itself became out of the money optionality. And that does happen. Sometimes the market just gets really.
You mean the multiples became so silly low for some companies in the last 6 months that.
Yeah. That effectively all future growth of the business was a free call option, but of course they're still going to grow. And so the market's corrected a little bit of that over the last couple of months.
It's so funny. I think actually there was a little more of that. Well, certainly that happened in public markets, but in private markets too, it was perhaps even more violent. Like there were some great companies in the private markets that were raising or considering raising rounds a few months ago at very attractive prices, and like there was no market for it, and everybody's just like, nope, we're sitting on our hands. It's like, wow, I mean, higher multiples than you're talking about, but these are for still small private companies growing, but with real meaningful revenue growing at 300% a year. You're like, okay, interesting. Larry, you have your hand up. Over to you.
Hi, everybody. Thanks for sharing some time with us. I had a kind of a question. It seems like innovation is accelerating. It took 100 years for Ford, then 20 years for Google, and then 10 years for Facebook, and then 3 years for TikTok. What effect do you think that has on complexity investing, if at all? Is the needle getting smaller and smaller that you need to thread to be right? Is the window of opportunity shrinking in time, the time dimension for you to hit the target on a given investment? So that's what I'm wondering.
Thanks for the question. Great question. We wrote about this, Larry, maybe not exactly, but I think it was our worst title paper ever, and I named it. It was something like finite time singularities and blah, 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 blah. I don't remember what else. But one book that we really enjoyed was Jeffrey West's book, Scale. Jeffrey, spell with a G. He's actually a quantum physicist, but he took a lens towards biology, and he wrote this book, Scale. And in it, he talks about finite time singularities, which is exactly what you're explaining. So if we think about punctuated equilibrium, right, like we have the steam engine, that's amazing innovation. But then we have oil come up, and then there's like first the lamp, but then all of a sudden cars get invented, and so you need it there, and then we have electricity, right? There's these punctuated equilibriums, and they're happening faster. And eventually what you come to as a singularity, right? It's like you can't do that forever. Eventually, like all the wheels will fall off, it'll blow up, and you have to start something new. Hopefully we don't get there in our lifetimes. But it is happening faster. So it undermines the notion of what resilience is. And so then you think about what's not going to change. Well, I don't know. My guess is like 15 years from now, railroads are still going to be the cheapest form of transportation, right? And so I think Buffett, it's amazing at this. He picks things that are not going to change. And then on the optionality piece, certainly the optionality churns faster, and fewer of them churn into resilience over time. And that time period shrinks. It's the reason owning one portfolio of all resilient companies or one portfolio of all optional companies is not optimal, which I see as sort of the heart of another question on the chat. Because if you just own resilient companies, you could be sitting here thinking Western Union is still resilient, right? And it's not, not even close. And if you just owned optional companies, you could think, that WeWork is still, has a maybe they do, has a viable roadmap in front of them, right? There's no disruption.
I hear Flow has a lot of potential.
Yeah, Adam Newman has a viable roadmap.
That's why it's on my mind. It's sort of like that unbelievable example. So you need both, and it requires this. There's a chapter in the paper about sort of mindfulness. It requires us paying attention, and then also requires the soil of the team, because that's where the debate happens.
And also maybe to tack on a little bit is there's a white paper, again, that Brinton and Brad wrote on our website called Redefining Margin of Safety. And part of the thesis behind that paper is, there are markets that are just inherently slower moving. And like there are a few markets we really like investing in. One is like analog semiconductors, like trailing edge, like in Texas Instruments, where a company might gain like 50 basis points of market share a year, which is very different dynamics than like social, where TikTok can come out of nowhere and just like steamroll the whole industry. Another one is like wireless towers, where there's 3 companies that own the real estate for wireless towers, and they'll probably be the same 3 companies in 20 years. And so when we're looking for resilience, you can kind of find these these pockets of industries where things change more slowly, and to the extent that things are changing in those industries, like you have more time to react because you're selling stuff that lasts for 10 or 20 years or has long-term contracts with price escalators. And then in optionality, I think you just have to find really adaptable management teams where adaptable cultures, I would say, where companies know that they might have a narrow window. And to be fair, like we're generally not looking for companies that kind of like can flare up and then flare down, like the Groupons of the world. And so we're not totally fishing there, but it's a really good point that things, a lot of industries are just seeing accelerating dynamics. That's just kind of the cost of doing business, especially when you're looking for highly optional companies.
I think that was the Pace Layers paper, right, Brinton?
That's what it was, Pace Layers.
Yeah, so Pace Layers is an interesting lens on this same question too. It's like, and to John's point, it's like there's like, I think of like the world as gears that spin at different speeds, and so a lot of this comes from this Pace Layers framework, which was developed by Stuart Brand of the Whole Earth catalog. And
yes,
he's with the Long Now Foundation, and so. This gets applied. The Pace Layers gets applied to a lot of things, but basically, like the fundamentally, like the big institutions, like governments and just religious beliefs, and sort of the foundations of society are the things that change the slowest, and then you can work your way up to things that change a little bit faster. I think of like sort of these gears spinning, and they're all adjacent to each other, and then you get to things like technology and fashion and art, which are like churning really quickly. And so it's really fascinating if you come across somebody like David Bowie, who was like tried to exist, or Warhol, who tried to exist at the intersection of art and technology. Those are probably the most fascinating people that you can learn from, because they are experiencing the gears moving the quickest of anybody. And so if something's going to change, they're probably going to see it first at those intersections. But the weird thing that's happened is the gears are kind of like, the layers are kind of mixing. And so you'd say like, well, the gear that's like the most solid one, and I promise we're not going to get political here, but the gear that's the most solid one at the bottom is those foundation of society, which would be like democracy. And of course that is just so foundational and it works so well, we're going to always have it. And then all of a sudden we get this example of like, oh wait, maybe we shouldn't take this fundamental layer of the world of civilization for granted, because technology is like this just missile kind of coming in and churning everything up right now. And that's where Jeffrey West's point about these complex adaptive systems is a good framework for explaining why things always have to happen faster until they don't, why ecosystems have to evolve faster and faster and faster until they find a point of equilibrium where that doesn't have to be the case. And we're not at that point of equilibrium. So it does create this just like uneasiness that I know I feel it. And I think everybody feels it at some level, consciously or subconsciously, about like, man, you look around and you're like, something doesn't feel super comfortable about this pace of change. And then you look at like what's happening with like AI, biology, with DeepMind creating an open database of every protein structure for any living creature on the planet that's now available for anybody to go do research with. And so we're really just even seeing this even faster acceleration of, I don't want to use the term AI as like a blanket statement, but I'll just use it here for that purpose of just saying like, whatever that pace was the last 20 years, it does look like it's going to be faster, even faster over the next 20 years. And so we're not prepared to comprehend what that means. So it does argue for Brinton's point of like stepping back and saying like, okay, well, what won't change? Like, can we anchor ourselves in those things that will still be hopefully true 10 years from now?
I assume I was thinking, smiling when you mentioned David Bowie. Were you referencing there's that great interview?
Yeah.
Just amazing. Well, I'll find it in a sec. I'll put it in the chat of.
Yeah, there's the short version, and then I actually just sent it to the team last night. There's the longer 16-minute version.
Oh, I didn't know there's a long version.
Find the full one. It's mostly on the same topic. There's a couple other things in there. But yeah, I mean, there's like, how was he able to see in 1999 the dramatically changing relationship between the artist and the consumer of that art? And he of course David hung out with Warhol a lot in the late 70s and early 80s, and I think he was really informed by, I'm not like an expert on this, but he was just really informed by this technology, or this interaction of technology and art. And this, one of the things he says in that longer version of the interview is he points out how we went from objective reality in the 70s to subjective reality. That's when subjective reality for humans, I think it's always been there at some level, but really started to balloon. And now we're, of course, in like the only thing we have is subjectivity now. No one's sort of really willing to commit to any objective view of reality anymore. And he was sort of like on top of that 23 years ago, and you kind of just think to yourself like, how can I do that today? How can I become that? How can I see where we might go that clearly today? It seems really hard to figure out.
So cool. We've got Rob has his hand up. A quick one before we then go to Rob from the chat. Hopefully this is quick. This is actually, depending on how philosophical you want to get on it, it could not be quick. How do you all think about WACC and weighted average cost of capital?
Let's get philosophical on this one, I think. I mean, it's actually funny because at our previous firm, like we did a lot of modeling, and that was part of the, I think it's just part of the culture at a lot of big investment companies, is kind of this false precision that Brad was talking about. So if we're like modeling call options on like a resilient company, we actually intentionally now don't really like model them out that precisely and say like, hey, the upside optionality, like the call option on this company is like, they can have a $10 billion business in 5 years. I can discount that back at some WACC, and that's like what it's worth today. And then the reason that we don't do this is because like I think we've talked about this a little bit on one of the episodes we did with you guys, but like the really amazing upside optionality, there's like no way you're going to get it right. In terms of the upside, when you're trying to run this kind of a model. Like I'm sure if you went back and looked at Mobison's model from the Amazon IPO, like there's no way that he discounted all the AWS at a $74 billion run rate was in his model at 30% EBITDA margins. Like my favorite example is NVIDIA. I actually did all this modeling when we were working together in 2016 or 2017 on their data center business. And I was like, maybe you can get to, $1 billion in 5 years, which would be like a 4X, which is huge in semiconductor land. And they 30X'd that business in like 6 years. So it's like, if you build a model and say this business can compound it 60% a year for 7 years, you get laughed out of the room because like, humans are not really trained to trust exponential compounding. And so like the really special companies, we're like intentionally careful now to actually not be too precise. But I mean, just in terms of our WACC, I would say we're generally trying to make double digits on every company we own. So that's kind of like our hurdle rate, our rough rate of return we're looking for. And you can argue with like a really resilient business, it should be lower than that, like Microsoft or Texas Instruments or something. Their WACC is much lower, but that's like our general framework around, and that was a little philosophical around WACC and modeling in general, but that's how we think about it.
I should have expected that.
Nice.
Love it. Rob, over to you.
Well, thank you. Thank you very much. This is really special tonight. And one of the things that have really caught my attention reading your work is between optionality and resilience in finding a balance. It's not like a constant midpoint, but being able to go from one end to the other. And I just wanted to ask you some questions, or if you could touch on the heuristics you apply for that movement. Because in my career, the high quality investors I've been fortunate to work with and be exposed to, that's a central skill that they seem to possess.
You're talking in terms of moving between the two buckets of the portfolio.
Yeah, exactly.
Yeah, there's some instinct in it. This is one of those answers where we want to be careful about balancing humility and confidence. We've been okay at it, which almost makes us uncomfortable to have been okay at doing that, because we shouldn't really have any special ability to know what's happening in the world to do that. But I think there are, we look at this expected return of our portfolio, we run an implied, like a real-time implied DCF on the entire portfolio. It's in our master spreadsheet that we all look at, and you can kind of see because our assumptions about the future don't change very much. We're not making very many, but we certainly don't change them that often. And so you can sort of see all things equal, like, oh, there's a lot of stocks that are implying an expected return, an implied return that is below what we think is attractive, which is kind of, to John's point, 10% a year over time, through a cycle. Or there's a whole lot of stocks that are implying like high teens returns, which is very unusual. And so I think just the fact that we look at this consistent group of quality growth companies a lot over time, we get a little bit of a sense about what to do. And then part of it's being just contrarian. Like, we're super we talked about things we've worried about today, but we're super optimists, and we know that whatever challenge comes is going to be solved. And if it's not going to be solved, then it sort of doesn't matter if we're investors in the stock market anyways. And so being super optimistic, I think, helps build that confidence when things are down a lot, to shift more into the optionality names that like what I was talking about with software last quarter would be a good example of that. Being able to sort of anchor on what we think won't change, that companies are going to go to the cloud. I think that's a pretty safe assumption. They're going to keep going, and we've really just begun on that. And then so I think that's part of it, and part of it's just is a little bit just, we've been doing this, all of us, for between 14 and 24 years now. So there's a little bit of maybe a feel. That's an answer I'm really uncomfortable giving, because that's, I feel like, is maybe we're more lucky than we think we are. But I don't know if anybody else has a better answer to that on the team.
I mean, the only other thing I would highlight is within the portfolio construction, we have this middle, which we try to desperately avoid, that actually forces decision-making properties. We really try not to in the portfolio own things that are above a certain percent and below a certain percent, because it crosses into what we call the middle. And so if optionality stocks are a host of them in the portfolio are doing really well and it gets in the middle, it forces us to really once again take a look and say, hey, has the range of outcomes for this particular stock changed so dramatically that it needs to be higher in the portfolio, or has the market pushed it there yet the range of outcomes are the same? And those are very two different actions depending on what your answer is there. And so when we have that middle, and it's very informative on what decisions we do. Same thing on the opposite side. If there's a resilient company that's being pushed down, has the range of outcomes widened, or has the market just undervalued the future cash flows of this company or the like? And so I think that also is something that we utilize within our portfolio construction framework that really forces decision, forces reflection on what has really happened. Did we actually get this right, or are we just being lucky right now and we're just not going to be lucky forever?
Yeah, that's a really great point. I hadn't thought about that, Joe, but there's like this emotional not allowing, we didn't talk about this for people who don't know, we only run small positions and large positions. We don't run anything in the middle, and not allowing something to drift up or drift down does cause these emotional signals that we can think about. Like if we say like, oh, this stock seems expensive, let's trim it a little bit, and be like, well, if you're going to trim it, you're going to take it all the way down to the bottom, because we don't allow ourselves to let things sit idle in the middle of the portfolio. And then you go like, oh, wait, how would that feel if we did that?
Can you get specific on large and small in terms of percentage of the portfolio, just to give people an idea?
Yeah, I mean, it depends on the strategy. And for everybody on this call, if you're running a portfolio, just simply depend on how many positions you run. We tend to like to run around 60 positions, which is, a lot of people would argue is high, but it's like 15 positions for us, it's greater than 2.5%, and kind of 40 positions that are below 1.5%. Those aren't like super hard. There's a tiny bit of fuzziness around those boundaries, but if something is like, if a stock is going up and all of a sudden it's a 1.6 in the portfolio, we discuss it. It forces a discussion. We have to decide, like, is the range of outcomes changing? Is it getting more narrow? Is it becoming more obvious that we might be right? In which case we don't let it sit there. We put capital and move it up to the top. Or is the range of outcomes the same or widening? We actively take it back down, take those basis points and reinvest them in more optionality. And then there are occasions where we just make large shifts between resilience and optionality because of these just kind of signals that are out there in the world or in the market, or as Brinton likes to say, if I get a lot of back pain.
Yeah, and I think that just it's kind of a key point that we tend to like flex between resilience and optionality kind of at the extremes, which like the last several years, there's been a lot of extremes in the market. But it's generally like not a daily thing that we're trying to say how much resilience or optionality do we have. It's more like November of last year, or when, optionality was historically expensive, or, probably this spring where there's kind of like a baby with the bathwater dynamic with like really high growth companies and optionality. And so that is, I think it's a little bit easier to find it at the extremes, or at least easier for us to kind of do this rebalancing and move capital between one or the other.
Yeah, this strategy I think works for us to be able to do this, and I think other people might find other strategies that work better for them based on their temperament. But it's about matching whatever your strategy is to your temperament, I think, as an investor. And this is the one that we found works really well, is to have this dichotomy in the portfolio that we stick to.
The important thing is just to avoid stuck in the middle. And I think, Rob, this is true with everything, portfolio construction and life. It's like you really want to have these friends that are lifelong friends, and you want to like make sure you pour time into those relationships. And the rest of the people you spend time with, you want them to be weird, right? Like, hey, I've solved quantum fusion. And you're like, wow, that's amazing. Let's talk. I mean, probably that dude needs to go to the loony bin, but if he doesn't, man, he's amazing, right? Or she's amazing. So it's this idea of resilience and optionality. Anything that's stuck in the middle, like, hey, do you want to go here tonight? Not really, but okay. Like, cut that out. Like, why? And in the portfolio, why? Mm-hmm. If the resilience is gone and the optionality is gone, let's get rid of it. Let's move on.
It's
Oh, go ahead, Rob.
Go ahead. No, it sounds like, almost if I was to summarize, it's a process that's driven by principles and experience that kind of drives you on that line, and your experience gives you the confidence to live with some uncomfortable landing points.
Yeah, and it's the team
It's the team.
to like function together and not get paralyzed and not have groupthink, and to challenge each other and to say, no, we can't add to that, or yes, we need to sell this. And but it's mostly just remembering those feelings when stocks are going down, that you're not as dumb as you think you are, and when stocks are going up, you're not as smart as you think you are. And just really internalizing that mentality, I think is for us, the way our team operates, is really important.
Thank you.
Oh, we do one other thing. Sorry, this is a technical point. We do one other thing, which is we will keep uncomfortably small positions in the portfolio, which is a lot of investors don't do. But if we're not sure, or we think we might revisit a stock in the future, but we think it's right to sell it, we will keep a very, very small, like 10, 20 basis points or something in the portfolio, because there's a psychological hurdle to adding. It's very different to add to something you already own versus buying it back when it's not sitting there in the portfolio staring at you. So that's a bit of a quirky thing we do to make sure that we don't miss something that we're afraid, because there have been stocks where we would literally go like, we had sold it completely and we said, well, if we owned a little bit, we would add to it. But since we don't own it, we don't add to it. It's like a weird psychological problem I think a lot of investors have. And that works for us, is to keep a small tail of positions. And we get criticized for it sometimes, but I think most people understand it.
This absolutely happens in the private markets.
I was just going to say, this is 100% a key lesson for the private markets.
If it's interesting to learn about how venture investors think, a very common thing is to keep reserves so that you can follow on your winners as they keep raising. And people talk about defending their stake, defending their ownership. But really, like, okay, your ownership you bought at a certain cost basis, and you're buying brand new shares at a brand new cost basis that other investors are. You should think about that as a completely different investment, rather than thinking about, well, I owned 8% and now I'm getting knocked down to 5.5 and I want to get to like 6.5. And so people, it's not necessarily a good money after bad situation, but people tend to think about it like, I want cash on hand, and that cash can flow very easily into new companies, into existing companies, especially because I have relationships with management, and I'm very updated on the business. I think I know more things than the next investor might, and I'm pot committed, and so that is like unbelievably easy to follow on to existing companies over and over and over again, and very difficult to add a new company.
All right, Andrew, I'm gonna get to your question in one sec. I'm gonna take executive privilege and insert one now, because I thought of it when we were in this last awesome topic, and Ben, it fits into what you're saying too. How does NZS, how do you all think about liquidity? And maybe you just don't. Like, is your mandate to stay fully invested as much of the time as possible? Or do you think about not being fully invested, or do you let your LPs drive it? Or
I would say the vast majority of our clients historically and currently, they will make their own cash decisions. And so if they've given money to us, it's because they want it invested. Now we can, to the prior question on flexing between resilience and optionality, if we think that now is not an appropriate time to be like heavily, in optionality names, we can hang out in like these incredible growth companies at reasonable valuations at the top of the portfolio and do that. But that's not a big consideration for us. Is our cash level is pretty much almost always zero, and we handle thinking about liquidity by flexing between resilience and optionality.
And the companies we own tend to be fairly liquid.
Yeah, like you could always, not talking about any position in particular, but to just use a favorite acquired example, like you can probably always buy more shares of TSMC or Texas Instruments or what else, and probably better than keeping cash anyway. So
yeah,
absolutely.
Andrew, over to you.
Well, I'm glad you used your executive privilege, since that was probably a better question than what I'm about to ask, but I'll try it anyway. So I'm just starting my career, and I'm really interested in just kind of learning about the world in general. So my question is kind of a two-parter. One, how do you all learn new things currently? And then two, do you have any like books, resources, or other publications you would recommend I read or look into as I'm trying to just kind of learn about, innovation and entrepreneurship and this whole kind of field?
I think it's a really good premise, Andrew, to start with. We've had a lot of people that we've trained over the years, and I think the one critical factor that we've learned we can't train for is curiosity. If the person's not genuinely curious about stuff, there's nothing really else we can do, but everything else is very simple to learn. The great lie in finance is that it's really hard. It's really not. You learned all the math by the time you were in junior high that you need to know to do active investing. So that's not hard. The rest of it is all just made up opinions and being overconfident most of the time. So, that's just silly. And then the rest of it beyond that is people hit options and then they explain it as skill. And so there's a lot of path dependency at the beginning of your career that really determines who makes it a far way along and successful and is on, books or CNBC or whatever. No offense, Brad. Right? There's a lot of path dependency, and so really this idea of being curious about everything is super important. There's a bibliography in the paper. It's a little bit dated now. Scale is a book that I would recommend in the meantime, between when we wrote the paper and now, but there's a bunch of others. I would just say, follow these really smart people and start reading. Definitely don't take experts' opinions for it because it's probably wrong. Don't take our opinion for it. We're probably wrong about stuff. We just don't know which stuff. That's why we're asking you guys, show us where we're wrong, right? That's why we have an open process. We always want to keep this open because we want to keep the process plastic. So it's this idea of reading a lot, finding a group of people that are like-minded and curious also, and discussing ideas, and then trying to disprove each other's idea in an environment that's safe, where the idea is not tied to your identity, right? It's just the idea. And so you're just trying to get to the truth.
Yeah, I would say like one thing that I say to people just like starting out also is it's like wherever your path takes you, you will not be successful without luck. Like nobody in the world who's successful today got there without some luck. There are some people who don't realize that you can read entire books and multiple books written by very famous investors who don't mention the word luck once. And then sometimes you can read a book by, like Bob Iger from Disney, who basically wrote a book about how lucky he got. And now he thinks he made some right decisions, but here's where I got lucky and here's where I got lucky. And if this hadn't happened, this never would have happened. If I hadn't met this person, never this would have happened. So the advice part of it is like create a landscape where you can get lucky. Mm-hmm. And so that is, reading as much as you can, meeting people, saying yes. Don't say yes to everything, but, say yes when it's uncomfortable, and just like find some way so that if luck somehow finds its way to your door, you don't like just sit there and not get up and answer the door. And that's not tangible advice, so I apologize for that. It's sort of intangible advice, but it is really having this like openness. And like one of the things like it's a little unusual to do what we do, which is to write everything down and then make it publicly available. And we really don't keep like secrets. Like there's really there's some things we're not allowed to talk about for like compliance reasons for actively trading something, but like there's nothing that we sit together and go like, boy, let's not tell anybody about this. If anything, like we probably tell people things we shouldn't tell them before we figured them out ourselves. But being really open like that, and just being really like a two-way door for information, that seems to be, from our perspective, the way to like let that luck shine through. I think that's the thing we all are really bad at, is figuring out how lucky we've been.
Just to pile on, I guess, since we all probably have our own answers to this. I do think like studying amazing companies, if only there was a podcast that did that, and made that easy for you to consume that kind of content. I think there's like probably 30 to 50 iconic, just like stories of amazing company building out there. And there are these patterns you pick up, like Bob Iger's book that Brad mentioned, or the Everything Store that Ben and David are talking about right now, or like Shoe Dog about Nike. I mean, there's so many, and there are lists out there on Twitter that like aggregate these. The one about Hunter Harrison, the railroader, I think it's called, about CSX and him transforming the railroad industry. Like there are just so many amazing company stories out there, and like the more whether you want to be an investor or build a company, there are lessons you learn. I mean, even like Brinton randomly like references like things he learned from Hunter Harrison, who ran a railroad, like in reference to NZS, the business, and how we can run our business differently. Like it's just funny the way you pick up little things. And then the other thing I would say, we were really lucky to kind of grow up in a big organization, because it's easier to develop mentors when there's like 90 people on your floor. They're all investors. But I think developing mentors is just so additive to your perspective. It makes it makes learning easier. And it also just makes whatever you're into much more fun, and it's usually rewarding for both sides. It's very high NZS, to plug our tagline, very high NZS relationship. And so to the extent that there are mentors out there that you can kind of facilitate over time, I think that's certainly from an early age or early part of your career, I think that's a great way to invest your time.
And just to pile on even for it, so we'll get all four of us on here. We mentioned it a little bit earlier, but don't be afraid to make mistakes, because those mistakes are great learning experiences. And the fact that it's tough to know what a great company is until you've learned what a bad company is. And so when you learn a bad company and you've made that mistake and you've learned from that mistake, I do believe that allows you to kind of grow and develop that humility, but also develop a more rounded experience in the industry.
It seems like it's kind of discovering the ends of the spectrum. It's almost like, how the human eye can only perceive a very tiny fraction of the whole EM spectrum, the visible light. It's like, this is all we know exists. And when you've had one job, you sort of like only know companies can be as awesome or as terrible as that company. And the more experiences you have, you sort of like understand the breadth of the spectrum. And I'm amazed, like I still, like we have a company in the PSL portfolio right now that's the fastest growing company that we've ever had in our portfolio. I've never experienced a company growing that fast, so I did not know that it could be that good. I've had lots of experiences where they went to zero very quickly. So like I think I'd hit the edge of like knowing how bad a company can be in the early stages, because they're super volatile. But like
you can always be surprised.
The spectrum continues to reveal broader edges than I thought were possible.
That's a really good point. We had a portfolio manager who we used to work with years ago, who said like, okay, I get that's what you think could happen, but tell me what could really happen. Like what could really go right? Like how big could this be? And it's not a question we are intuitively good at. And then, of course you don't want to like rely on that, but to not have contemplated how good this could be. And it's another example of trying to do a pre-mortem of like, how could this be the best stock we could ever invest in over the next year, 10 years? Like what would have to happen? And what questions would we ask today to figure out whether that could happen or not? But I think that's a good point, is to see both edges more clearly.
That's such a good little acquired foreshadowing here that at least used to be, I don't know if it still is, like a core part of the benchmark investment decision making process of like, okay, like what if things really, really, really go right here? Like really go right. Is it worth it?
Yeah, you have to have a great imagination in this business, because if you don't, you're going to miss a lot of things.
Or to your pandemic point earlier, like I didn't have to imagine that the pandemic could happen. I just had to know that a bunch of insane things could happen, and I had to sort of construct my investments to contemplate some chance of the world completely changing from the way it was today, without specifically knowing pandemic or when.
Right. And I think portfolio construction is such a big piece of that, because often very famous investors, what happens is they put optionality names at the top of the portfolio and they hit 23 black, 3 times in a row. And then all of a sudden they're writing books, right?
And probabilistically, someone was going to hit 23.
Someone's going to do that. It's in the distribution set every time. Absolutely. But when you go into one of these bad events and you actually have the base of the portfolio, the lowest downside risk at the top of the portfolio, the highest asymmetry at the bottom, then, it stings, but it doesn't kill you.
All right. We probably have time for one more question. If anybody has a burning one. Also, Andrew, that was a fantastic question.
Yeah, thank you.
for it. And good luck as you are starting your career. Let's see.
I highly recommend you read. I put a link to, this is the third republishing because he took down the original of Mark Andreessen's Guide to Career Planning. This was on a blog that he wrote that predates launching Andreessen Horowitz. It was the PMark blog, which is his sort of handle forever. It's like I read it on the plane out to Seattle when I was starting my first job after leaving college and starting at Microsoft, and it blew my mind at how intentional you can be about planning your career while also maximizing the surface area for luck should it hit you.
All right. Well, if nobody else has a burning question, I have a good last one. Any last call? Okay. Which is what NZS white paper should we cover next on Acquire? Because we're recording on Thursday.
Well, we really like this redefining margin of safety. Brad sent it out on Sunday in that version, so that would be my vote. But we progressed a few ideas that we'd written about in 2013. We wrote this one in 2019, and we progressed a few of the ideas in the paper. So that would be my vote, but I'd be open to what the other guys think.
I think it's a good one. It's the one I think it's a little bit more consumable than our 45 page paper.
But there's no good pictures, no DeLoreans, which is a
not
bummer.
there's not as many. There's a couple charts, but
We could do some
sadly,
time travel pictures because there's definitely time travel inside of it.
Did I tell you guys I tweeted about this? I saw the Back to the Future DeLorean. Jenny and I were driving across the Golden Gate Bridge.
I saw this.
Yeah,
out of time.
On a trailer. There's a pickup truck with a trailer, and it had the Back to the Future
original.
DeLorean. I was like, I cannot believe this. I'm driving
That's
across the
amazing.
Golden Gate
Well,
Bridge.
no, because
There's
I've
the-
seen like 3 or 4. How do you know it was the? Because most people
It had
who have
it had
DeLoreans
the Fusion.
trick it
What's it?
out.
Fusion-O-Matic.
Mr.
Fusion. It had Mr.
Yeah,
Fusion
I had the
on
Mr.
it.
Fusion. So it wasn't the out of time plate. It was like the space barcode plate, right?
Yeah.
Yeah.
Brinton,
I mean, maybe it was a
Brinton
replica, but
Brinton modeled most of his life after Back to the Future movies. Didn't you have Michael J. Fox's truck at one point?
For 20 years.
For 20
Not at
years.
one point.
Not
Yeah.
at one point. Not his actual truck, but the same model. Yeah.
Yeah, I know. It was awesome. Heavy,
Yeah,
man.
no, I do think that's a good paper to cover because it is one. I sent it out in the newsletter last week because last week got away from us and we couldn't get the newsletter out. The responses to that paper for people who haven't read it does seem to be one that really clicks with people. Like we get a lot of feedback of like, oh, I've been trying to articulate that point. So I do think that's a good clarifying paper for people.
We basically took a Buffettism and tried to explain it in a little bit more sort of, I don't know, holistic way.
Yeah.
all right, I
Sweet.
just put it in the chat. Any dissenting opinions? Are we going with that?
I already started reading it before this because I thought that,
Okay.
that we were doing that anyway. So I'm glad consensus agrees with the work I've already put in. Also,
Great.
Brinton, you have to download this picture. This was my Halloween of 2013, something like that. Buddy of mine has a DeLorean, and so I borrowed it to stage.
Dude, where
photo.
did you get the hoverboard?
Oh,
So he has a DeLorean, so he of course had a hoverboard in his trunk. He's like, I just gotta have this thing with me all the time. So those are the only 2 elements I didn't own, but the rest was thrift shopped.
That's amazing.
Oh,
Still waiting for the hoverboard. Still waiting.
Well, they sort of exist now in a
Yeah.
very lame way.
Very lame.
I'm just hoping when we get the hoverboard that it's going to work when it's on water, because that was the biggest downfall of that.
Not unless you have power.
Not unless you have power, nerds.
All right, on that note, thank you so much, everyone.
Thank you.
Thank you.
thanks for having us,
Thank you.
guys.
Thanks
I
everybody.
appreciate it.
Thank you all.
We'll see you guys soon.
Later.